February 2026. Silver just did something it hasn't done in 46 years. It collapsed, then exploded in the same week. Tuesday morning, silver dropped 8% in 90 minutes. No news, no catalyst. Just a brutal algorithmic sell-off that looked like every other precious metals manipulation you've seen for the past decade. By Friday, it was up 23% from the Tuesday low. The highest single-week gain since 1980. Not 1980s. 1980. The Hunt Brothers Silver Corner. The most famous short squeeze in commodity history. Here's what nobody's telling you about what just happened. This wasn't a squeeze. This was a warning shot. The real squeeze hasn't started yet, but when it does, it won't just destroy silver short sellers. It will expose the most dangerous fraud in commodity markets. Paper contracts that outnumber physical metal by 100 to 1. There are roughly 1 billion ounces of silver mined per year. Global above-ground stockpiles are estimated at around 2 to 3 billion ounces available for investment and industry. The notional value of silver derivatives and paper contracts traded on exchanges, over 100 billion ounces equivalent. Read that again. 100 billion ounces in paper claims, 2 to 3 billion ounces of actual accessible metal. This works fine as long as nobody asks for delivery. The paper market sets the price. The physical market follows. Buyers and sellers trade contracts. Almost nobody takes physical possession. But something changed in February 2026. Industrial buyers started demanding physical delivery, and the exchange couldn't provide it. For the first time in decades, the paper market and physical market disconnected. Paper silver crashed because algorithms sold. Physical silver spiked because industrial buyers were paying premiums of 15 to 20% above the exchange price just to get metal. The discount said, "We have infinite paper, sell it." The premium said, "We have no physical metal, pay whatever it takes." Those two prices can't coexist for long. When they converge, one of two things happens. Either the paper price crashes to zero because the contracts are worthless, or the paper price explodes to match physical scarcity. Either way, the banks and institutions short those contracts are destroyed. Let me show you why this is happening now. Silver isn't gold. Gold is money, a store of value, central bank reserves. Gold sits in vaults doing nothing, and that's fine. Silver is industrial. 60% of silver demand comes from industrial applications. Solar panels, electronics, batteries, medical devices, water purification. Silver is consumed, used up, gone. And consumption is accelerating. In 2000, solar panels used about 1 million ounces of silver per year. In 2024, they used over 140 million ounces, a 140-fold increase in 2 decades. Electric vehicles use 2 to 3 times more silver than internal combustion vehicles. Every charging station, every grid upgrade, every renewable energy project, all require silver. Global silver demand in 2024 was approximately 1.2 billion ounces. Mine production was roughly 830 million ounces. That's a 370 million ounce deficit. Deficits get filled from above-ground stockpiles, but those stockpiles are shrinking fast. The COMEX, the primary exchange where silver trades, reported having around 300 million ounces in registered inventory available for delivery in early 2024. By February 2026, that number dropped below 150 million ounces. Half the registered inventory vanished in 2 years, and industrial demand is still accelerating. Here's where it gets dangerous. The COMEX silver market trades roughly 150 million ounces per day in paper contracts. That's the entire registered physical inventory changing hands digitally every single day. But almost none of those trades result in physical delivery. It's a casino. Speculators buying and selling contracts with no intention of taking metal. This works until someone demands delivery and the exchange can't provide it. That's what started happening in February. A major solar panel manufacturer, name unreported but confirmed through supply chain sources, attempted to take delivery of 10 million ounces from COMEX contracts. Standard industrial hedging, nothing unusual. The exchange couldn't deliver the full amount, and they offered cash settlement at a discount. The manufacturer refused. They needed the physical metal for production. Word spread. Other industrial buyers started demanding delivery, worried that if they waited, there'd be nothing left. Within days, registered COMEX inventory dropped by 30 million ounces, the fastest drawdown in decades. The paper price crashed because the short sellers, mostly banks and hedge funds, panicked and sold more contracts to suppress the price and shake out speculators. But the physical market didn't care what the paper price said. Industrial buyers needed metal. They paid premiums. The spread widened. And that spread is the crack in the dam. Because if physical buyers can consistently get better prices outside the exchange than on it, the exchange becomes irrelevant. And if the exchange becomes irrelevant, the paper contracts become worthless. The banks holding short positions, betting silver prices would fall, would be forced to cover in a market with no physical metal available. That's not a short squeeze. That's a short annihilation. In 1980, the Hunt brothers tried to corner the silver market by buying physical metal and futures contracts. At the peak, they controlled over half the global silver supply. The price went from $6 to $50 in a year. Then the exchanges changed the rules, increased margin requirements, restricted buying, forced liquidation. The Hunts went bankrupt. Silver crashed back to $8. The lesson Wall Street learned: control the paper market, and you control the price, regardless of physical supply. For 40 years, that lesson held. Silver price suppressed through paper contracts. Physical market too small to matter. Industrial buyers absorbed the available supply without disrupting the paper casino. But the math changed. Industrial demand exploded, stockpiles depleted, and for the first time since 1980, the physical market is bigger than the paper market can suppress. February 2026 was the warning. The real squeeze happens when industrial buyers collectively realize the exchange can't deliver and they all demand physical at once. When that happens, the paper price won't just rise, it will become completely disconnected from reality, and the short sellers won't be able to cover because there's no metal to buy. Let's talk about how we got here. Silver has been in a structural deficit since 2021. That means global demand exceeds new mine supply every single year. The gap gets filled from above ground inventories, recycling, old stockpiles, investor selling, but those sources are finite, and they're shrinking faster than anyone expected. The Silver Institute reported that identifiable silver stocks, bars, coins, and exchange inventories dropped from around 1.7 billion ounces in 2020 to roughly 1.2 billion ounces by late 2024. 500 million ounces gone in 4 years. That's 3 years of current deficit at current consumption rates. But consumption isn't staying current, it's accelerating. The International Energy Agency projects that solar panel installations will triple by 2030. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. If projections hold, solar demand alone could consume 300 million ounces per year by 2030. Add electric vehicles, 5G infrastructure, grid upgrades, and you're looking at total industrial demand approaching 1.5 billion ounces annually. Mine supply? Declining. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices are low, mines shut down or reduce production. Silver output drops even if silver prices rise. New silver mines take 7 to 10 years to develop. Even if prices spike today, significant new supply won't come online until the 2030s. The math is brutal. Demand rising, supply flat or declining, inventories depleting. In a normal commodity market, prices would rise until demand destruction occurs or new supply comes online. But silver isn't a normal commodity. The paper market controls the price, and the paper market has infinite supply. Here's how it works. Banks and bullion dealers sell futures contracts, promises to deliver silver at a future date. They sell far more contracts than they have physical metal. This is legal. It's called fractional reserve commodity trading. As long as most contracts are cash settled instead of physically delivered, the system works. The bank collects fees on every trade. The price stays suppressed because they can always sell more paper. But this creates a hidden short position. Every paper contract sold without physical backing is effectively a bet that the buyer won't demand delivery. The total open interest, outstanding contracts on COMEX silver, is typically around 150 to 200,000 contracts. Each contract represents 5,000 ounces. That's 750 million to 1 billion ounces of paper silver, against 150 million ounces of registered physical inventory. 5 to 7 times more paper than metal, and that's just COMEX. Add London's LBMA and other exchanges, and the ratio hits double digits easily. This worked for decades because industrial buyers sourced metal from miners and recyclers, not exchanges. Investors traded paper contracts for price exposure without wanting physical delivery. The physical and paper markets stayed separated. But now industrial buyers can't get enough metal from traditional sources. Mine supply is tight. Recycling can't keep up. Stockpiles are depleting, so they're turning to exchanges, demanding delivery, exposing the fractional reserve fraud. And the banks are trapped. They can't deliver metal they don't have. They can't buy metal to cover shorts because there's not enough available. And they can't keep selling more paper because industrial buyers are walking away from the paper market entirely. Let's look at what happened to registered COMEX inventory more closely. January 2024, 310 million ounces registered. June 2024, 270 million ounces. December 2024, 190 million ounces. February 2026, 145 million ounces. That's a 53% decline in just over 2 years. And the decline is accelerating. In the 2 weeks around the February price swing, 30 million ounces left registered inventory. That's the fastest drawdown since the 2011 silver spike, when silver briefly touched $49. But in 2011, The drawdown was driven by investment demand, people buying silver as inflation hedge. The price rose, hit resistance, speculative buyers sold, inventory stabilized. This time, the drawdown is industrial. Solar companies, electronics manufacturers, battery producers. They're not selling when price rises. They need the metal for production. Price is irrelevant if you can't get supply. This is demand destruction in reverse. Higher prices aren't reducing demand. They're increasing urgency to secure supply before it's gone. And here's the critical part. Industrial buyers can't be shaken out. In 1980, when silver hit $50, the Hunt brothers were leveraged speculators. Exchanges raised margins. They couldn't meet calls, forced liquidation, price crashed. Solar panel manufacturers aren't leveraged speculators. They're buying silver because without it, their factories stop. You can't make a solar panel without silver paste for conductivity. There's no substitute at scale. You can raise margins on futures contracts all you want. It won't stop a manufacturer from paying cash for physical metal they need to keep production running. The exchanges have no leverage over industrial physical demand. This is why February was different. The price drop was pure paper manipulation, algorithms selling futures to suppress price, but physical buyers didn't care. They paid premiums and took delivery anyway. The manipulation failed to achieve its purpose, shaking out buyers and stabilizing inventory. Now, look at the short interest. The Commitment of Traders report, published weekly by the CFTC, shows positioning of different market participants. In late 2024, commercial traders, mostly banks and dealers, held net short positions of around 300 million ounces. That's twice the registered COMEX inventory. These aren't hedged positions. The banks don't own 300 million ounces of physical silver they're hedging. They're naked shorts, selling contracts they can't deliver on. In a normal market, this would be insane. But in precious metals, it's been standard practice for decades. Why? Because the price suppression benefits everyone in the financial system. Low silver prices mean low inflation signals. Easier for central banks to claim inflation is under control. Easier for bond markets to stay stable. And as long as physical demand was manageable, the suppression worked. But now physical demand is unmanageable, and the short sellers are about to learn what happens when you sell something you don't have to buyers who actually need it. The Hunt brothers' squeeze in 1980 was a failed corner attempt. They tried to control supply through buying. The system fought back and won. This squeeze is different. Nobody's trying to corner the market. Industrial demand is organically exceeding available supply. There's no single entity to target, no leveraged position to liquidate, no rule change that fixes the underlying shortage. The system can't fight back against thermodynamics. Solar panels require silver. Electric vehicles require silver. You can't print physical silver the way you print paper contracts. And when the industrial buyers collectively realize the exchanges can't deliver, they'll bypass exchanges entirely. They'll pay whatever it takes to secure physical metal from miners, recyclers, and remaining stockpiles. The paper price becomes irrelevant. The short sellers can't cover. And the banks holding those short positions face unlimited losses. Not theoretical unlimited losses. Actual unlimited losses. Because unlike stocks, where short losses are capped at market cap, commodity shorts have no upper bound. If silver goes to $100 and you're short at 20, you lose 80 per ounce. If it goes to 500, you lose 480. And if you're short 300 million ounces at 20 and price goes to 100, you're down $24 billion. For context, that's more than the entire market cap of several major banks. This is why February's price action matters. It wasn't the squeeze, it was proof the squeeze is possible, proof that physical and paper markets can disconnect, proof that paper manipulation can't suppress physical scarcity forever. The shorts saw what happened. So did the industrial buyers. Now it's a race. Can the shorts cover positions before industrial demand drains remaining inventory? Or will industrial buyers drain inventory before shorts can cover, forcing a catastrophic squeeze? Based on current drawdown rates and accelerating industrial demand, inventory hits critical levels within 12 to 18 months. That's the timeline. Not for silver to go up, for the paper market to break entirely. Let's talk about what the actual squeeze looks like when it happens. It won't start with price rising. It will start with delivery failures. A buyer exercises their futures contract, requests physical delivery. The exchange issues a notice. The short seller, the bank or dealer who sold the contract, has a few days to deliver the metal. They don't have it. They need to buy it. But registered inventory is depleted. The metal they need isn't available at current prices, so they offer a premium. Cash settlement at 10% above contract price. The buyer refuses. They need physical metal, not cash. The short seller scrambles, calls other dealers, offers 20% premium, still can't source enough metal, defaults on delivery. The exchange steps in, forces cash settlement, pays a penalty. Seems manageable. But now word spreads. Other contract holders see that delivery is uncertain. They demand delivery while they still can. Suddenly 50 contracts request delivery. then 200, then 1,000. The exchange doesn't have the inventory. Short sellers can't source metal. Cash settlements pile up. Penalties increase. Buyers realize the contracts are worthless if they can't be delivered. They sell paper contracts and buy physical metal outside the exchange at whatever price necessary. Paper price crashes. Physical price explodes. The spread hits 30, 40, 50%. At this point, the exchange has three options. Option 1, suspend trading. Declare force majeure. Cash settle all outstanding contracts at some arbitrary price. This destroys faith in the exchange entirely. Future silver trading moves to physical-only markets. COMEX becomes irrelevant. Option 2, change the rules. Raise margins dramatically. Limit position sizes. Restrict delivery requests. This is what happened in 1980. But it only works against speculators. Industrial buyers who need physical metal will just leave the exchange and source elsewhere. Option 3, emergency intervention. Government or central bank provides silver from strategic reserves to stabilize the market. But the US government sold most of its strategic silver reserves decades ago. There's nothing left to provide. None of these options end well for short sellers. Option 1, they're holding worthless contracts they sold at $20, while physical market trades at $70, they're bankrupt. Option 2, trading restrictions. Force liquidation of their shorts at whatever price the market demands. They're bankrupt. Option 3, government silver floods the market temporarily, but industrial demand still exceeds supply. The shortage resumes within months. They're bankrupt slightly later. There's no scenario where the shorts escape without catastrophic losses. And it's not just the shorts themselves, it's the systemic risk. Most of these short positions are held by major banks. JP Morgan, HSBC, and others have been named in silver manipulation lawsuits and settlements over the years. They hold enormous derivative books. If silver squeezes to triple digits, the losses on those derivative positions could exceed bank capital reserves. We're not talking about a hedge fund blowing up. We're talking about systemically important financial institutions facing existential threats. And unlike 2008, there's no bailout mechanism that fixes this. You can't print silver. You can't inject liquidity into physical commodity shortages. The banks either have the metal or they don't. Now let's talk about why solar demand specifically makes this squeeze inevitable. Solar panels use silver in the metallization paste that creates the electrical contacts on the solar cells. This is a consumptive use. Once the panel is manufactured, the silver is effectively gone. It's economically impractical to recover silver from old panels. In 2020, the average solar panel used about 120 milligrams of silver. By 2024, improved efficiency brought that down to around 90 milligrams per panel. Sounds like good news for silver demand, right? Wrong, because panel installations are growing faster than efficiency improvements are reducing silver intensity. In 2020, global solar installations were about 140 gigawatts. In 2024, over 400 gigawatts. In 2030, projected at over 1,000 gigawatts. Even with silver content per panel dropping 25%, total silver consumption tripled because installations nearly tripled. And here's the critical constraint. You can't reduce silver content much further without sacrificing panel efficiency or lifespan. Manufacturers have been trying for years. There are hard physical limits. Some research suggests replacing silver with copper or aluminum. But at scale, the efficiency losses make it economically unviable. Solar economics depend on maximizing power output per panel. Switching to less conductive metals reduces output, which reduces revenue, which makes projects unprofitable. So solar manufacturers are locked into silver consumption, and governments worldwide are locked into aggressive solar deployment targets for climate goals. China plans to add 500 gigawatts of solar by 2030. The EU, another 200 gigawatts. The US, roughly 300 gigawatts. That's 1,000 gigawatts of new capacity, requiring approximately 90 million ounces of silver per year, just for solar panels. Add existing replacement demand and other industrial uses, and you're looking at total industrial demand of 1.2 billion ounces annually by 2030. Global mine supply? Around 850 million ounces, growing maybe 3% per year if we're optimistic. The deficit is structural, permanent, and growing. Above-ground stockpiles are being consumed at 300 to 400 million ounces per year. At current rates, identifiable stockpiles reach critically low levels by late 2027 or early 2028. When stockpiles deplete to the point where industrial buyers can't source metal reliably, they'll panic buy. They'll offer any price to secure supply chains, and that's when the paper market dies. Because paper contracts become worthless when nobody's willing to sell physical metal at paper prices. The price discovery mechanism moves entirely to physical market, and physical market has 2 to 3 billion ounces of total accessible supply against 100 billion ounces of paper claims. The repricing is mathematically inevitable, If even 10% of paper contract holders demand physical delivery, 10 billion ounces worth, the system breaks instantly. There's no mechanism to deliver 10 billion ounces that don't exist. The February spike was a preview. 30 million ounces of delivery requests caused visible stress. Imagine 300 million, or a billion. The exchange would collapse within days. And here's what makes this truly catastrophic. Silver isn't just COMEX. It's London. It's Shanghai. It's regional exchanges worldwide. The fractional reserve fraud is global. If COMEX breaks, trust in paper, silver evaporates everywhere. Every exchange faces simultaneous delivery demands. Every short seller scrambles for physical metal that doesn't exist. Global financial contagion from a commodity most people have never thought about. This is why the banks are terrified, why February's price action triggered emergency meetings, why you're starting to see quiet inventory builds by some institutions. They're trying to cover before the dam breaks, but it's too late. The inventory doesn't exist to cover all the shorts, and industrial demand isn't stopping. The squeeze is coming. The only question is timing. Based on inventory drawdown rates, critically low levels hit in 12 to 18 months. Maybe sooner if industrial demand accelerates faster than expected, or if investment demand kicks in as people realize what's happening. February 2026 was the warning shot. The real squeeze happens when registered inventory drops below 50 million ounces and industrial buyers collectively panic. That's the threshold. Below 50 million ounces, a single large delivery request could drain half the available inventory in days. When that happens, the paper market doesn't just crash, it ceases to function entirely, and everyone holding short positions gets annihilated. Here's what this means for you. You probably don't own silver. You probably don't trade commodity futures. So why does a silver squeeze matter to your life? Because the banks getting annihilated in the squeeze are the same banks holding your deposits, managing your retirement fund, and backstopping the commercial paper market that keeps corporations functioning. In 2008, Lehman Brothers collapsed and nearly took down the global financial system. Lehman's balance sheet was roughly $600 billion. JP Morgan's total assets exceed $3 trillion. HSBC, $2 trillion. These institutions hold massive derivative books across all commodity markets. If silver squeezes to $150 or $200, which is plausible if paper markets break and physical scarcity sets pricing, the losses on bank silver derivative positions could exceed $50 to $100 billion. That's not a rounding error. That's a systemic event. And unlike 2008, you can't fix this with liquidity injections or bailouts. The problem isn't credit markets freezing. It's physical commodity shortage. Central banks can't print silver. Governments can't decree that industrial demand stops. The solar panels still need to be built. The batteries still need silver. The electronics still require it. The shortage is real. The losses are unavoidable. What happens when a major bank announces catastrophic losses on commodity derivatives? First, credit markets seize. Nobody wants to lend to institutions with unlimited potential losses on commodity shorts. Counterparty risk explodes. Second, regulators panic. Emergency meetings. Potential trading halts. Maybe forced position liquidations, which accelerates the squeeze. Third, contagion spreads. Other commodity markets get examined. How much paper gold exists versus physical? What about copper, platinum? If silver's paper market was fraudulent, what else is? Trust in commodity exchanges evaporates. Physical-only markets emerge. Price discovery chaos. This cascades into real economy fast. Industrial buyers can't hedge input costs if futures markets aren't trustworthy. Manufacturers can't plan production. Supply chains seize. And all of this because we allowed banks to sell 100 times more silver on paper than exists physically. The timeline looks like this. Q2, 2026. COMEX registered inventory continues declining. Drops below 120 million ounces. Small delivery squeezes keep happening. Premiums for physical metal stay elevated above paper prices. Q3 2026. Inventory breaks below 100 million ounces. Industrial buyers start securing supply through multi-year direct contracts with miners, bypassing exchanges entirely. Paper market trading volume declines as physical buyers leave. Q4 2026. A major delivery default occurs. Exchange forces cash settlement. Class action lawsuits filed. Regulators investigate. Paper prices become increasingly disconnected from physical reality. Q1 2027. Registered inventory drops below 50 million ounces. Critical threshold. Multiple large delivery requests overwhelm available supply. Exchange suspends physical delivery temporarily. Paper market crashes. Physical market explodes. Q2 2027. Banks report billions in losses on silver derivatives. Emergency regulatory intervention, potential exchange closures or forced consolidation, physical silver trades at triple-digit prices, while paper contracts settle for pennies on the dollar. This isn't speculation. This is following the math to its logical conclusion. Current deficit, 370 million ounces per year. Current accessible stockpiles, roughly 1.2 billion ounces. Current drawdown rate from registered inventory, approximately 150 million ounces per year. At these rates, accessible stockpiles reach critically low levels by late 2027. Registered inventory reaches critically low levels potentially by Q1 2027. The only variables are how fast industrial demand accelerates and whether investment demand kicks in early. If retail investors or institutions start buying physical silver in anticipation of the squeeze, it accelerates the timeline. If industrial buyers panic and try to secure a multi-year supply all at once, it accelerates the timeline. The base case, assuming current trends continue, gives you 12 to 18 months before the system breaks. Now here's what you can actually do with this information. If you're an institutional investor, understand that paper silver is worthless in the scenario described. If you hold silver ETFs or futures for commodity exposure, those positions may not be deliverable in physical form when you need them. Consider whether physical allocation makes sense. If you own physical silver already, you're positioned for the squeeze. The question is whether you hold through it or exit during the spike. Physical silver could genuinely reach triple digits if the paper market collapses, but timing the peak is nearly impossible. If you're considering buying silver, understand the difference between paper and physical. Paper silver, ETFs, futures contracts may not be redeemable for metal when it matters. Physical silver requires storage, insurance, and has higher transaction costs, but it can't be printed or created through fractional reserve schemes. If you don't care about silver investing, pay attention to banking sector stability. If major banks start reporting unexpected commodity derivative losses, that's your signal that the squeeze is happening. Consider what that means for your deposits, credit access, and market stability. The broader point is this: we've built a financial system where paper claims massively exceed physical reality. This works fine until someone demands the physical. Silver is just the most obvious example right now because industrial demand has overtaken available supply and exposed the fractional reserve fraud. But the same dynamic exists in other markets: allocated versus unallocated gold, oil futures versus actual crude inventory. The entire derivatives complex is built on the assumption that physical delivery rarely happens. When that assumption breaks, when buyers start demanding physical settlement en masse, the system has no backup plan. The banks can't deliver what doesn't exist. The exchanges can't force supply into existence. The regulators can't decree that physics changes. And the losses fall on whoever sold promises they couldn't keep. In silver's case, that's the banks. And the losses could be catastrophic enough to trigger systemic instability. All because we allowed a paper market to become 100 times larger than the physical market it supposedly represents. February 2026 showed us the crack in the dam. The water's starting to seep through. The question isn't whether the dam breaks, it's whether you're positioned for the flood when it does. February 2026, silver collapsed and exploded in the same week. 46 years since anything like that happened. 46 years since the Hunt brothers tried to corner the market and failed. But this isn't a corner. This is consumption overwhelming supply. Industrial demand exceeding what mines can produce and stockpiles can provide. Solar panels, electric vehicles, 5G infrastructure, battery technology, all consuming silver faster than it can be replaced. And on top of this physical shortage, we've built a paper market 100 times larger than the metal backing it. 100 billion ounces in paper claims, 2 to 3 billion ounces of accessible physical metal. That math doesn't work. It never worked. It only appeared to work because nobody demanded delivery. Now industrial buyers are demanding delivery, and the exchanges can't provide it. COMEX registered inventory dropped 53% in 2 years, currently sitting around 145 million ounces, declining at 150 million per year. At current rates, inventory reaches critical levels within 12 to 18 months. When it does, the paper market doesn't just crash. It ceases to exist, because paper contracts become worthless when they can't be delivered, and short sellers can't cover positions when there's no metal to buy. The banks holding those shorts face losses that could exceed their capital reserves. Not theoretical risk, actual realized losses as they're forced to cash settle contracts at prices that reflect physical scarcity rather than paper manipulation. If silver reaches $150 to $200 in a genuine squeeze, which is possible when 100 billion ounces of paper claims chase 2 billion ounces of physical metal, the derivative losses at major banks could trigger systemic instability. This isn't 2008, where you can inject liquidity and restart credit markets. This is physical commodity shortage. You can't print silver. You can't decree that solar panels don't need it. The shortage is real. The squeeze is inevitable. The timeline is visible. February was the warning, the delivery stresses, the inventory drawdowns, the disconnect between paper and physical pricing. The shorts saw it. So did the industrial buyers. Now it's a race to the exit. Can the shorts cover before inventory depletes? Can industrial buyers secure supply before the panic? Based on the math, no, there isn't enough metal for everyone who wants or needs it. Something has to give. Either industrial demand destroys the paper shorts through relentless delivery requests, or the paper market collapses preemptively as participants realize the contracts are worthless. Either way, the people holding physical silver win, the people holding paper lose, and the banks sitting on massive short positions get annihilated. This is the 46-year shock. Not because silver's price moved, because the fundamental structure of the market is breaking in real time. The paper market controlled silver pricing for decades, kept it suppressed, made it seem abundant and cheap. But you can't suppress physics, you can't print metal. And when industrial consumption exceeds available supply, paper manipulation becomes irrelevant. The dam is cracking. February showed you the seepage. The flood is coming.